For more reaction to Netflix earnings, let's bring in Loop Ventures founder and Fast Money friend Gene Munster. Gene, great to see you. What'd you make of the quarter?
Hi, Mel. I thought that it was positive relative to expectation, but the move in the aftermarket masked the underlying cautious trend that we've seen in the business here. I think your recap has largely covered this, but I just want to emphasize this piece is that ultimately, for this to work, they need to have margin expansion and continue to grow subs. And we're entering a multi-quarter of really uncertainty. I also, when we think about their guidance and relative to the uncertainty and some of the comments they've had to help investors frame in December, it's important context that historically this has been a company that has given guidance and exceeded the sub guidance. In the June quarter, they missed by 47%, and then they took this a more conservative view on September, and they missed that by 3%. So this concept that this now 20% decline in their guidance for December is a safe number, I think that is unknown at this point. And I think, Mel, you hit it right on the head, too. It's just not about the December quarter, but ultimately what happens in March. And so I think that this was positive to expectations, but this is still a story that I think would be difficult to own. It is still a $140 billion market cap here. This is compared to Disney at $240 billion. This is still a big market cap relative to what's going on in the underlying business.
What levers do they have to pull to expand margins at this point, Gene?
I was surprised at I don't know the answer to that. I was surprised at the commentary that they're going to expect margin expansion for next year, that 300 basis points. I don't know how you get there, because the easiest way to get there, obviously, is through price increases, which is now off the table. I think that is a hard off the table. And you continue to need to fund this with quite aggressively. The one opportunity is if they can get cheap debt. They have $12 billion in debt now, and continue to fund content with debt. There may be an opportunity to have some sort of trade-off there where they can get margins to inch higher. But I think that is at the core question. How do you compete in a more, how do you operate expanding margins in what is a very different competitive environment than we had a year ago?
So, Gene, when you look at Apple and you look at Google, when you look at Apple and you look at Disney, they have other sources of revenue to fund their content curation and whatever else that they're looking to do. When you look at Netflix, they are a one-trick pony. A, can Netflix compete against that? And B, does anyone buy Netflix with this valuation just to do a plug and play, or is that ship has sailed?
I think on the acquisition side, at this point, the ship has sailed, especially given what we're talking about. You can imagine conversations in a boardroom that look at the recent pullback of Netflix over the last 6 months and think of the opportunity there. They're asking the same questions about the next year. This business could be valued very differently a year from now. In terms of the business model, and they're making money on their kind of unique content where Disney has other avenues and Apple does too, I think that's a critical point to the story. And what that really means is that those other players, Apple and Disney, can sustain lower prices longer. Essentially, they can freeze out some of the Netflix price increases. Now, if they decide to move higher, Disney and Apple, on their pricing, that may leave some oxygen for Netflix, but I see that as unlikely over the next year.
Let's flip the script, though, Gene. I mean, could Netflix be wanting to buy some sort of library of content itself? Would it be able to do that?
They could. I think at their debt load right now, it would be unlikely. I want to be clear, too, is Netflix is going to be around in 5 years. They're going to have subscribers. It should not be a $130 billion market cap in my analysis. I think that avenues to advance what they're doing in content through some sort of acquisition, I think would be modest compared to competitively what's going on.
So what should it be then? If not 130 in market cap, what should it be?
It's for the investors to decide, but it's a 45 multiple on next year. I think probably a more reasonable multiple would be more like a 25 multiple.
Wow.
So maybe I think that just seems reasonable.
All right, 20 turns lower. Grade it, Gene, the quarter.
I'm going to give it a C+. The stock reaction would suggest a higher grade, but ultimately this trend is there's some cautionary tales here, and So I'd stick with a C+.
All right, Gene, great to see you. Thank you.
Thank you.
Gene Munster of Loop Ventures. C+ for a low-quality pop in the after-hours
I'm so
session.
happy I wasn't in Professor Munster's class back in school, man. That's crushing. But a C+ was
you
actually
agree?
a very good grade from him. No, you know what? I would agree. And I'll tell you what, Steve talks about positioning. It's absolutely about positioning. Because if this stock came in trading 325, we'd be talking about an entirely different story right now. It just got people off sides. Fourth quarter revenue guidance, below the street. Domestic ads, half of what the street was looking for the fourth quarter. International ads, 1 million less than the street was looking for. Just to believe what they're telling you. I mean, they're telling you next quarter is not going to be great. So if they're telling you that, this is a great opportunity to take profits in the name.
And it should be a good quarter for them, actually, right? That's supposed to be one of their strongest parts of the year is into the fourth quarter. And then all of a sudden, the competition really starts to accelerate after that. So I think Gene C+ makes a lot of sense to me. The outlook wasn't very good. I still look at Netflix. This is a trading stock. I look at Disney as a hold stock. I own Disney. I've owned it for a long time.
Apple.
I continue to hold on to it. Apple as well. I'm just curious, I wonder who Gene thinks is the most competitive, who's really going to knock Netflix out. I mean, I think there's somebody out there. Yeah, the combination of all of them. But I think there's.
What if they don't knock Netflix out, but they simply curb growth?
Right.
It is priced for growth.
Right.
If they curb that growth, what multiple
And
is it?
I would actually answer my own question with Disney.
Okay.
And the reason I say that is because
It'd be the first time someone agreed with you.
well, once in a while anyway. But the reality is when you look at what Disney is and what they're putting out there and the content that they have, which actually goes to the area we want really when you're looking at where you're looking right outside of there, the younger children, all that category below the 25-year-old type crowd. That's what they want. Disney's got that, and I think that's why Disney's a huge threat.